Tax mistakes just before you retire can have a devastating effect on your life. As you approach or dive into retirement, financial knowledge becomes even more critical. Something as dull as taxes could potentially throw a wrench in your golden years. But don't worry, it's not all doom and gloom. With the right knowledge and strategies, you can sidestep these taxing pitfalls. Stay tuned as we delve into these common tax mistakes and how you can avoid them. One of the most common mistakes retirees make is simple math errors. Additionally, many underestimate their tax liability. Now, you might be thinking, how can I, a seasoned adult, make math errors? Well, tax forms can be complex and the numbers can get muddled. It's easy to transpose numbers, make calculation errors, or even miss adding in certain income sources. One common math mistake is failing to correctly tally up all sources of income. This includes not just your retirement account withdrawals, but also any part-time work, rental income, or even large sales, like selling a house. These all contribute to your gross income, and failing to account for them correctly can lead to you underpaying your taxes. Now, what about underestimating tax liability? It's often an overlooked aspect of retirement planning. Many people think that once they retire, their tax burden decreases significantly. While it's true that your income may decrease, your tax liability might not. The tax brackets are progressive and your tax rate depends on your income level. If you have significant income in retirement, whether from a pension, investments, or other sources, you could still be in a higher tax bracket. Also, keep in mind that certain types of income, like withdrawals from traditional IRAs or 401(k) keys, are taxed as ordinary income. You might have been deferring taxes on these accounts during your working years, but now it's time to pay the piper. So, it's essential to consider your tax liability as part of your retirement planning. Don't assume that because you're retired, you're automatically in a lower tax bracket. And certainly don't neglect to factor in all sources of income when calculating your taxes. We can't stress enough how important it is to double-check your math and to consult with a tax professional if you're unsure. Remember, it's not just about avoiding penalties. It's about making sure you're not giving Uncle Sam more than his fair share of your hard-earned retirement savings. So, double-check your calculations and always be aware of your potential tax liability. Another common mistake is failing to take the required minimum distributions from retirement accounts. Also, did you know retirees may be eligible for tax credits? This is where things get interesting. Let's first dive into what required minimum distributions, or RMDs, are. When you reach the age of 70 and a half, you must start withdrawing a certain amount from your retirement accounts each year. This is your required minimum distribution. The exact amount depends on your age and the balance in your account at the end of the previous year. Why is this so important? Well, if you fail to withdraw the required minimum distribution, you could face a tax penalty of up to 50% of the amount that should have been withdrawn. That's right, half of it. So it's crucial to stay on top of these distributions to avoid such a hefty tax penalty. Now, on to tax credits. A tax credit is an amount of money that can be offset against a tax liability. For retirees, there are several tax credits that you might be eligible for. For example, the credit for the elderly or the disabled, which is available to those aged 65 or older, or those who are permanently and totally disabled. You might also qualify for the Retirement Savings Contributions Credit, also known as the Savers Credit. This credit is designed to encourage low and moderate income taxpayers to make retirement contributions. Understanding and taking advantage of these tax credits can really make a difference in your retirement finances. It's like leaving money on the table if you don't explore these options. So, in conclusion, it's crucial to understand the importance of taking your required minimum distributions to avoid hefty tax penalties. And don't forget about the various tax credits you may be eligible for. They can significantly reduce your tax liability and potentially put more money in your pocket. Ensure you take your required distributions and explore all possible tax credits. Remember, retirement should be a time to relax and enjoy, not to worry about tax penalties and missed opportunities. Before we continue with more tax strategies, please consider subscribing to our channel for all the latest personal finance tips and tricks. The more informed you are, the better off you will be. The tax implications of claiming Social Security benefits and paying off mortgages are often overlooked. However, understanding these can make a significant difference in your financial health during retirement. When it comes to Social Security benefits, they can be taxable depending on your income level. If your total income is above a certain threshold, up to 85% of your benefits could be subject to taxes. This is why it's crucial to factor in these potential taxes when planning your retirement income. Similarly, when paying off your mortgage, you might be losing out on a potential tax deduction. The interest paid on your mortgage can be deducted from your taxable income, reducing your overall tax liability. However, if you pay off your mortgage entirely, this deduction is no longer available. So, it's all about balancing your financial decisions with their tax implications. For example, you might want to consider paying off your mortgage slowly to keep the tax deduction, while also planning your income in a way that minimizes the tax on your Social Security benefits. Always consider the tax implications when claiming Social Security benefits and paying off your mortgage. It's all part of making your retirement as financially comfortable as possible. Avoiding these common tax mistakes can help you enjoy a stress-free retirement. Let's quickly recap what we've covered. First, we addressed the pitfalls of math errors and underestimating tax liability. It's important to double-check your calculations and understand your tax obligations to prevent unexpected bills. Next, we discussed required minimum distributions from retirement accounts and potential tax credits. Make sure to take out the necessary amounts from your accounts to avoid penalties and explore all the tax credits you may be eligible for. We also touched on the tax implications of claiming Social Security benefits and paying off mortgages. A nuanced understanding of these topics can greatly benefit your financial health. To sidestep these common mistakes, consider consulting with a retirement accountant. They can provide valuable insights and guidance tailored to your situation, helping you make informed decisions. Remember, knowledge is power. Stay informed and make your retirement as enjoyable and stress-free as possible.